MMTLP was not a stock. It was a Series A preferred share issued as a dividend following a reverse merger completed in June 2021 between Torchlight Energy Resources, a NASDAQ-listed oil and gas company, and Meta Materials, Inc., which at the time was listed on the Canadian Securities Exchange. As part of that merger, Torchlight's oil and gas assets were placed into a Series A preferred shares to be held by shareholders until those assets were sold or spun out. Those preferred shares were never intended to trade. No Form 211, no issuer approval, no shareholder vote. Yet, in October 2021, an unknown third party, not the issuer, requested that the ticker symbol MMTLP be assigned to those shares and made tradable on the OTC market against the company's stated intentions, against company wishes. That alone is highly irregular. But what happened next is far worse. In July 2022, Meta Materials announced plans to spin out the Torchlight oil and gas assets into a new private non-trading company called NextBridge Hydrocarbons. MMTLP shares were designated to be exchanged for common shares of NextBridge once the spinout was completed. The SEC approved that spinout in November 2022. Shareholders were repeatedly told by brokers, OTC markets, and FINRA that they would be able to trade MMTLP through December 12, 2022, before settlement. But on December 9, 2022, just days before settlement, FINRA imposed a U3 trading halt, an extraordinary halt reserved for emergencies. A U3 halt means no buying and no selling. No warning, no exit, no answers. More than 65,000 Americans were locked in, including over 200 military veterans who trusted the system they served. Retail investors were trapped, while short positions were frozen in place. But short sellers who had made millions were never forced to close. Broker-dealers who loaned out the shares to those short sellers avoided billions in exposure. If this were about settlement risk, trading could have been extended. If this were about fraud, the rules already provided remedies. Instead, the sell button was removed. This wasn't investor protection. What followed wasn't just financial damage. Families were destroyed, businesses collapsed, life savings were erased. Some investors lost their homes, some lost their livelihoods, and tragically, some took their own lives under the weight of what this halt did to them and their families. This was not an abstract market event. This was real harm to real people. 3 years later, a FOIA request produced a bombshell. Emails showing direct communication between the Financial Information Forum, a trade organization representing major broker-dealers, and senior officials at the SEC, discussing a 2023 corporate action by NextBridge Hydrocarbons that would have required shareholders to transfer their shares to the transfer agent, not a broker-dealer. Transfers that could have exposed unreconciled short positions, shares that did not exist, inside a non-trading company after FINRA's U3 halt. Behind closed doors, regulators and Wall Street coordinated, not to unwind the damage, but to manage it. Let me be very clear. The FIF represents broker-dealers. FINRA claims to regulate those broker-dealers independently. The SEC is supposed to oversee FINRA, not coordinate with a broker-dealer lobbying group about the fate of a specific security. And yet, they did. Behind closed doors. This isn't about a bad trade. It's about a system protecting itself. The emails show regulators and brokers confronting a simple reality. There were not enough real shares. This FOIA email is a smoking gun. The facts are documented. The harm is real. And it leaves one unavoidable question. Who were they really protecting?